In this presentation, we will take a look at the future value of annuities. As we consider the future value of annuities, we want to keep that same picture in mind that we had for the present value and the future value, that being our two time periods, either now or in the future, and the question of would we rather have the $100 today or the $100 in the future? The answer obviously typically being we would rather have the $100 today, or if we want to think about this in a different method, the question being if we want the same purchasing power as the money today or in the future, then the amount of money someone would have to give us in the future would have to be higher than the amount of money we would have today in order for us to value them the same. That's kind of the core concept that we want to consider with the future value and the present value and the relationship between the two. When we're considering the annuity payments, then we're talking about a series of payments. So we have a series of items, a series of cash flows, those cash flows in set consecutive intervals such as years. So we have the same dollar amounts and they're going to be in some intervals that are the same. Then we may be able to apply an annuity type of calculation. In this case, we're taking a look at the future value type of calculation. And if we put that into the scenario, if we're considering a future value, the most common type of calculation or thought process or application of the future value is for us to think of this as some type of investment. So in other words, if we were to put $100 in a year from now, 2 years from now, 3 years from now, then how much would we have at the end of that time period? And we could think about it as actually how much we would have 3 years from now in actual dollars at that time period, because that future amount is going to be in future dollars. So we're going to have those future dollars in that future time period amount, as opposed to us taking these payments and bringing them back to valuing them at the current time period. So that's typically the scenario that we would want in our head. We're going to have a series of payments. We're going to apply some type of interest rate. Remember that that interest rate might be considered the interest rate that we would have in order to account for the time value of money, such as inflation, the purchasing power going down. That would typically be in normal years between like 1 and 5%. Or in the case of an investment, we're considering how much value we can get within the investment. We might be considering opportunity costs, where we can put our money someplace other than the investment, to consider how much our investment would grow as compared to another place that we could put our money. So that can be a little bit confusing when we think about the future value and the consideration of what it means to be future value versus the present value, because obviously when we consider the future value and the rate that we're using the rate of return oftentimes when we're considering the investment, us investing in something, receiving a rate of return. The future value then will be the actual dollar amount at that future time period, that future time point. We can think of the future value of an annuity in terms of a formula. That formula can be derived from the future value formula of a single sum. In other words, if we were to think about this scenario where we had 3 cash flow payments, we had $100 in year 1, $100 in year 2, $100 in year 3, and we want to find the future value at, say, 10% being the rate, we could then take the future value for each of those time periods, add them together, and we would get a future value of 331. Or we can use this formula up top, which will basically be derived from this concept, and apply that information into our future value of an annuity. We can use this formula, which will be more simplified, 1 calculation rather than 3, or you can imagine this going out for a long extended period of time, in which case the future value formula would be useful to use. However, it is more of a complex type of formula. We don't often use it in this format in practice because we'll use something like Excel, or if you're in schools, they'll usually use tables to do that. They're often not going to make you use the future value of an annuity formula because it is a bit more of a complex formula. Our goal really isn't the math, to understand the math behind it, but the application of it. So oftentimes within schools, we'll be using tables. So the tables are useful because they allow us not to have to focus on just math doing the formula, but on practical practice, although they don't make us use calculators that might have other functions that they don't want in tests. We can use a simple calculator and then use the tables, which are similar to what we would use in practice, which would typically be something like Excel. So remember, there's going to be 4 tables that you're going to basically be using and seeing. If you see this in like a school problem and a test problem, you're looking for the future value tables now, so you can eliminate the present value tables. And then you want to pick up the future value of an annuity if you're looking for consecutive payments, multiple payments that you're going to calculate with one calculation. We have the rates up top. We have the periods on the left-hand side. We're picking up the 10% at the rate, 3 years in terms of the numbers of periods. That is 3.31 is going to be the amount. And note, that's kind of what we would expect it to be because we had 3 payments. If we had 3 payments of $100 times 3, you would expect that to be 3. That's 300 if there was no time value of money, no future value. And we're expecting it to be higher than that because we're valuing it at the later date. At the later date, and you could think of it as an investment. If it's the later date, it's going to have earned some kind of return on investment. So it's got to be something a little bit higher than the 300. It's got to be something that's going to be multiplied by something higher than the number of periods. Periods are 3. It's going to be multiplied by something a little bit higher than the periods you would think, given the fact that it's going to be future value of money. If we do this calculation, then we're going to take our $100, we're going to multiply it times the 3.31 that we got from the table, and that gives us our 331. So the future value of these 3 cash flows then, 331. Now we've seen that happen 2 different ways. We used the formula, which we probably don't actually use in practice or even in test questions too often. We'll use the tables in test questions typically, and Excel being the 3rd option that we'll usually use in practice. You really want to know these formulas within Excel, within practice. We're going to be in the Formulas tabs. We're in the Function Library group, and we're selecting the Insert function. This is where we can search for the appropriate function that we want. If we search the function, we're looking for the same function, the future value. The future value is used for both the future value of 1 and the future value of an annuity. We're just going to use different functions within that system. So we want to be able to know that. It's nice that that's the case because we can just use one future value, and then we just need to know how to apply them to the future value of 1 versus the future value of an annuity. We're working on an annuity here. So first we need the rate. So here's the rate. The rate's going to be up top. It's going to be in B4. So here's B4. That's going to be the 10%. 10% is what we have. And then we need the number of periods. That's going to be in cell B2, which of course is 3. So in B2, we have 3 as the result. And then we have the payments. This is the area that differed. When we had the future value of 1, we put 0 here, and then we put the present value of 1. The payment means that we're going to have a payment for the annuity that's going to happen. Repeat payments, 3 payments, in other words, of $100 in this case. So if we put an item here and we put a number of periods, the system is saying, oh, you're talking about an annuity that has 3 items, 3 payments. So that's what we have, $100 in the payment. That gives us the answer of the 331. It's negative because that's typically the way the system will produce the answer. We can put a negative in front of it if we want to flip the sign, as we'll see in the next slide. Here's the actual formula that we're looking at. We could also enter it into Excel in this format. Equals negative. I put negative just to flip the sign to make it a positive number. FV, future value, brackets, and then we're looking for the rate. The rate is F4, B4. So here's B, here's 4, so that's 10%. And then we have comma to go to the next function. Number of periods, that is B2. So B2, which of course is 3. And so there we have that, and then comma to go to the next function, and then we have the payments, the payment, not this one. We're in the payment. So the payment is in B3, which is $100. These 2 are not required, so we don't need to add anything to those items. This is all we need for the annuity. And again, this last one is kind of the tricky one. We had, if it was present value of 1, this would be 0. If we're talking about an annuity, as we are here, and a future value of 1, this would be 0. If we have a future value annuity, as we do here, then we're going to be using the amount of the $100 in the payment amount. Remember that we can use this goal seek feature if we need to search for or find some other variable that is within the future value of an annuity type calculation. So for example, if we wanted to find the rate or if we wanted to find the periods and we knew all other information, we don't really need to look for and find and know how to have a separate type of formula within Excel and memorize 3 different types of formulas. We can use the future value and we can use goal seek to figure out what the missing value is. So in other words, we can use the future value formula here, and we can use Excel to say, I know what this answer is. Would you please tell me what the rate is given this information? And by doing that, we don't need a separate function up here. We can use the future value to figure out what the rate should be. The same with the periods. The point, and if you want to look at that, we'll have Excel sheets and we'll work through that in Excel to show how that is done. The point here is that we can really get a lot out of just knowing the present value formula, the future value formula. That gives us the present value of 1, the present value of an annuity, future value of 1, future value of an annuity, and the ability to look up these other items, the number, the rate, and the number of periods as the unknown, if that is the situation we're looking for as well. So we can do a lot with really just knowing those 2 main core functions, the present value within Excel and the future value within Excel.